Hello, everyone, and welcome back to the Property Trio. I'm joined, as ever, by my lovely co-hosts, Cate Bakos and David Johnston, with a T. Won't make that mistake again. How are we?
Very well, thanks, Mike. Mortlock.
And through the magic, thank you, Dave. Through the
With a
magic
T.
of editing and when these things are released, it probably won't be relevant, but it's a big happy 50th birthday to Cate Bakos as well, who celebrated since our last recording.
Happy birthday, Cate. Are we allowed to say that number, Mike?
Yeah, I don't care. I'm the wise one in the group now.
Yeah, that's right. Well, you always were.
All right. Well, we're going to unpack a lot of that wisdom today, because despite this sort of being, I suppose, a strategic mortgage broker's sweet spot, this is actually your episode, Cate, because you've got a background in that and quite a lot of experience as a multi-property portfolio owner. We're talking about LVRs, how they've changed over the years, the difference between standalone LVRs and cross-securitization, different security types, pros and cons, and those sorts of things. So we hear LVR a lot on the show, and for the uninitiated, we're talking about the loan-to-value ratio, arguably the most integral part of the loan approval puzzle because it's determined by the deposit. But LVR relates to a lot more than just the deposit, and there are many different rules and policies that relate to varying dwelling types when it comes to minimum LVR. So today, we're going to unpack all of that, and I'm going to start with you, Dave. Give us a 101, a brief intro into LVRs.
Yeah, so look, the loan-to-value ratio, ultimately it's driven by, as you said, your savings or your equity in your existing properties. Ultimately, less than 20 words or less, it's the percentage of a loan relative to the value of the property or properties that's securing it. So a very simple example: the property is worth $1 million. The loan value is $800,000. Well, that's a loan-to-value ratio, or an LVR, of 80%, because the loan is 80% of the value of the property.
So whether you're chipping in with deposit or equity, you're chipping in nonetheless. So it's like, what are you putting in? What's the bank putting in? So even I can understand that. Cate, coming back to you, and given this was your suggestion for an episode, why is LVR so important when it comes to things like mortgage insurance?
Yeah, so once you trigger typically an LVR that's over 80%, so Dave used the example, $200,000 deposit and $800,000 loan on $1 million property, that person typically on a normal residential property wouldn't pay mortgage insurance. And let's remember, mortgage insurance doesn't protect us, it protects the bank. Now, once you're going over 80%, in a lot of cases you do trigger mortgage insurance. There are special offers that banks sometimes have going where it might be an 85, sometimes a 90 deal where there's no mortgage insurance. Typically people that get an exemption above 80% are particular professionals that the banks love. So doctors, lawyers, accountants, they sort of vary from bank to bank, but they get special treatment. They can often go up to 90, and same with some high net worth clients that banks might look after. But the issue with mortgage insurance is the mortgage insurer can sometimes be tougher with their scrutiny on the loan, and they have the final say on the loan approval. Sometimes they're tougher than the bank assessors themselves, and there are some aspects of the property that a mortgage insurer might not like, they might not have an appetite for, whereas a lender might. So whenever you're going into that LVR territory of mortgage insurance, you have to be really careful about making sure the property you've picked will absolutely be something that the mortgage insurer will accept, because they can sometimes deliver the bad news at the end of that loan assessment period.
So it was sort of sounding fairly simple that unless you are a preferred occupation or you've got more money than God, 80%'s the magic number. But you're now sort of saying, well, you know, there's some nuances to how that LVR sits depending on where we're kind of purchasing. What can you unpack on that, Dave?
Yeah, well, look, it's important to talk to your strategic mortgage broker, because each lender has its own policy when it comes to loan-to-value ratio thresholds. LMI waivers as well can fall into place for different professions for high LVR loans, generally up to 90%. So you might be a doctor or an accountant or a lawyer or some other high-end professional, and you might qualify to not have to pay mortgage insurance if you borrow up to 90%, which is obviously an advantage in terms of saving more on mortgage insurance, but also not having to save as much money to get into property and also to be able to get into more properties faster. So it's quite an advantage. Some other sort of factors you need to understand with lenders' mortgage insurance is you often have interest rate differences. So once you borrow above 80%, the interest rate will often be higher than if you're able to borrow with a loan-to-value ratio of under 80%. Often the assessment changes, so you actually proportionately can't borrow as much money when you're borrowing above 80% as if you're borrowing below 80%. Often the income requirements and loan assessment the verification processes will be more stringent. And that can be particularly make it more difficult for complex or fluctuating incomes like those of self-employed individuals or contractors to get approved above 80%. There's property type restrictions. So if you are purchasing a property that might have an unusual type of title, it might be under 50 square meters, it might be part of a very high density apartment, you may not be able to borrow above 80% on those. There's also postcodes, so different postcodes you can't borrow above 80%, and that's generally postcodes like, for example, in postcode 3004, which is St Kilda Road in Melbourne. There's lots of high-rise apartments. That can be a postcode that is less likely to be able to borrow above 80%. There's also, particularly if you're a first-time buyer, a requirement for genuine savings to be shown, that you can save, in essence, when you combine your rent and your savings, the amount of loan repayment you'll be up for versus just getting a gift and then being able to take out the loan. So, there may be different policies for owner-occupiers versus investors versus first-time buyers when you're borrowing above 80% as well. So look, as you can see there, that's a reasonable old list of why it can be quite complex.
I was just about to say, well, that's been our episode on LVRs. But
no, it's Dave raises all of those interesting points about different title types and zoning, etc. And it's why we've talked about avoiding commercially zoned properties or industrial zoned properties that might look like houses and feel like houses when you are LVR sensitive. So if you've got a 20% deposit, great, but you won't be able to finance something that a lender considers a commercial security. So a lot of people get that wrong. They assume that because it looks like a house or it looks like an apartment, that it will be financed as a residential security, and it's not. And this is the thing that brings it all undone. It's the LVR restriction.
And I've seen you do presentations before, Cate, where simply crossing a road changes things dramatically from a zoning and a lending point of view. What else have you observed in that space?
Dave touched on some of those sensitivities when he said title type. If you think about a company share or a stratum unit, you hear a lot of that kind of talk down here in Melbourne, but I know that it's not just limited to Melbourne. They will potentially take a buyer out of the race if the LVR restriction is at 60%. And the same goes for vacant land or a property that's uninhabitable and considered land value only. You might then find that you thought you could finance it with a 20% deposit and you need 40. So there are lots of things that lenders are sensitive to that people shouldn't just assume. If a property has had fire or flood damage, for example, it just comes down to how it's assessed. And so if a bank valuer is walking through it and there's an issue, you need to have a plan B or make sure you're subject to finance.
Yeah. If you have any concerns, you really should get the contract looked at by a strategic mortgage broker and or your lender prior to purchasing, because the last thing you want is you purchase a property where you think you're borrowing 90 or 95% and you can't borrow above 80% for it.
Yeah, that was actually going to be my question to you, Dave. How do we know ahead of time? Because you would assume once you get a pre-approval, you can take that to the bank as an expression that sort of doesn't work in this specific example.
The bank already has that.
The bank already has it. Don't take it to the bank. That's just silly, just an expression. But yeah, so getting the contract reviewed, and of course your strategic mortgage broker can definitely help you with that, obviously. Just last week we were talking about our own first purchases. It was a lovely little nostalgic trip down memory episode. Cate, you mentioned the horrendous landline to mobile phone bills. Dave, the listeners were reminded about the good old days before there was a realestate.com. We're really
reading the classifieds.
Yeah.
We're all showing our age here. Lending policy around LVR has changed substantially over the years, much like technology. Dave, when did LVRs start to change from a maximal point of view in the land of lending?
Yeah, look, it's interesting. So Lenders Mortgage Insurance, or LMI, was another acronym for our listeners, was introduced to the Australian economy in 1965. So since its introduction, LMI has improved efficiency, equity, and risk management in the Australian home lending market. It's obviously allowed people to get into property with less money saved. The Housing Loans Insurance Corporation was established by the Australian government in 1965 to provide this lender's mortgage insurance, and it essentially was introduced to help more Australian people purchase their first home by using a smaller deposit, which is what we all know it for nowadays. It is why, which we've talked about as well, it's a bit ridiculous when people use examples of 20% savings and how long that would take to get into the property market, when it's now been, next year will be 60 years that we've been able to actually borrow above 80%. It's not like it's a new invention anymore, but yet we still refer to this yesteryear ratio when we're looking at how difficult and expensive it is to get into property.
I just want to unpack that quickly for a second, because I've had arguments with journalists about it, and we always sort of see these articles about, it takes 47 years to save a 20% deposit. And of course, those sound like horrible figures, and definitely it's harder to buy a house today than it was 20 or 60 years ago. But we're not representing the reality. I don't know any first home buyer that's saving a 20% deposit, and most property investors aren't going to be purchasing at an 80% LVR on a new purchase unless they're sophisticated down the track or they've got some sort of weird risk strategy. Dave, you mentioned that the Parliament sort of suggested that was an improvement to efficiency, equity, and risk management. Did they get it right? Is this an appropriate kind of thing that we have in the market today, or given the asset price to income ratio, is it due for a revisit?
Look, I think they've pretty much got it right. You can borrow 95% with most lenders on a new home, 90% on investment. The odd lender will still allow you to go to 95% plus funding your lender's mortgage insurance, but you'll generally pay a higher interest rate for that. So you can borrow like sort of 97, 98, 99% if you want to. So I think they have got it reasonably right. We have pretty low arrears in our country, despite the fastest rate rises in history. Our arrears are still very low. So if anything, I think, it's probably still a bit too hard and a bit too difficult to access money. But I think when it comes to high LVRs, possibly we could even make it a bit easier again, if anything. But, as an overall point of, is it right to have been able to increase and borrow up to 90, 95% or above? The answer is yes, versus keeping it at 80%, in my view.
Well, there are ways that I guess it has been made easier outside of that sort of standard LMI stuff. Cate, what's your stance?
Well, I do agree with Dave. To a point, I think genuine savings count for a lot. I mean, I remember back in the day when we had all the grants and boosts being thrown at first home buyers, and with them alone and with house prices where they were, people had more than a 5% deposit when they combined their grants and their boosts. And that can sort of distort a market, particularly when a boost is related to a new dwelling or a regional dwelling. You can have an explosion of activity when you are, stoking the fire with government offerings. But back to the point, it certainly made home ownership better and easier for a lot of Australians being able to get into the market earlier and get on that property ladder. And I remember Pete Coalizos saying LMI is a cost of doing business, which is a nice way of looking at it. But I also hate the fact that it's this enormous burden that is shouldered by the young first home buyer in a lot of cases for the benefit of the bank. And something that I think that our government has done really well, it's one thing that they've got right in relation to housing policy and first home buyer activity, is the first home guarantee. I think it's one of the best policies that we've had because it's not distorting the market. It's allowing people to get in early and it's not burdening them with capitalised mortgage insurance fees. But I also think, if I'm being critical, 35,000 places per year is not enough. And when you think about the cost of social housing and all of this rigmarole that we're going through now with, Labor's housing reform suggestions and the Greens and Liberals blocking all of their activity, it's just got really messy. I think for the cost of putting more places out there for eligible applicants for this first home guarantee, and also, if people don't realise, there's also a 2% offering for eligible single parents, which I think is amazing. And that should be extended to other people that really need a helping hand, and more numbers available. I think that would go a long way to helping with our housing crisis and getting more people into home ownership.
Absolutely agreed. The 35,000 sounds like a lot, but it's really a drop in the ocean with the demand that's out there for it. Cate, I want to ask you about LVRs in terms of a metric to track our prudential regulators' level of concern. We're talking about APRA here. So macro-prudential policy intervention is evident when we look through the history books at high LVR loan origination. What does the current 5-year data show us on that front?
Yeah, I pulled this chart out of the Core Logic pack so anyone can access it, and we'll pop it in the show notes. And it's interesting. It shows the percentage of loans originated with an LVR that's greater than 90%. And you can see that figure really peaked, particularly for owner-occupiers, through the COVID rush. When we were in lockdown and we had the heated market of 2020 and 2021, that's when it peaked. And then it pulled right back once they adjusted interest rates. And we obviously saw lenders restricting high LVR lending as well. What's really interesting, though, is we pulled investor high LVRs right back. And it takes looking at the previous 5 years to see how that affected the split of high LVR loans. But in this case, we've got currently 3.21% of investor lending is over 90% LVR, but we're up at 7.9 for owner occupiers. It peaked in 2021 at 14.1. So that's a lot of loans that were being written for people that were borrowing over 90%. And at the time, money was cheap and it was a really competitive housing market. And people were saying, I don't care, I'll borrow as much as I can get my hands on. I need to get into this market. And that was a real reflection of FOMO. And you do tend to see high LVRs in a FOMO market because people don't have that natural willingness to draw a line in the sand and say, whatever I can borrow, I only want to borrow X. They're then saying, I want to borrow as hard as I can and as much as I can, particularly when interest rates were cheap.
Yeah, and we've gone through quite a tumultuous time when it comes to macroprudential regulation. A lot of people will know about the APRA intervention, particularly impacting investors between 2014 and 2019. Before we really knew it, lending became tough, despite quite accommodative interest rates, credit was almost impossible for investors, with banks having caps on the percentage that they can have as interest-only loans, and of course LVRs in the mix as well. Dave, can you talk the listeners through this time and those tough restrictions and what impact that actually had on the broad property market?
Yeah, so little history lesson here for our listeners. So between 2014 and 2019, that period, it was really significant for the property market and the mortgage market because of APRA's interventions. So back then, property prices, particularly in Sydney and Melbourne, were surging, and there were concerns about affordability, financial stability, and the risk of the ubiquitous housing bubble forming, particularly due to excessive investor activity. It was off the charts relative to historical levels. So by early mid 2015, investor lending accounted for almost 50% of all new housing loans. So it got up to 48% across the country. To put that in historical and pretty much current perspective, it's generally sat around 33%, give or take. About a third of properties purchased were investment properties. In Sydney, investor loans actually got as high as approximately 55 to 60% of all new housing finance commitments. And in Melbourne, it was up at about 45 to 50%. So first in December 2014, APRA introduced a cap on investor lending growth for the major banks, and they were not able to grow their lending by more than 10% per year. So this cap effectively reduced the number of new investor loans that could be written, and therefore less money going to investment properties and the property market overall. What lenders did to bring these numbers down was, this is when they brought back in, which they used to have when I first was doing mortgage broking 20 to 25 years ago, investor loans were higher than owner-occupied loans. Then over a period, they became the same rates. So at this point, again, they started making investor loans more expensive to reduce the number of people who take them out. And that still exists, that disparity between rates. So they got to about 25 to 50 basis points higher. What they also did at that point in time, you pretty much could get 95% on every investment loan, just as you could on every owner-occupied loan. But then they brought them right back to typically capping them at 80%. Now they've increased them to 90%, and some lenders are pushing back to 95%. So that was a major change as well. They tightened the criteria on lending for investors. They also scaled back discounts, fee waivers, and other promotional offers. So in December 2014, APRA raised the serviceability buffer for the first time. So it's been talked about a fair bit just in the last week or so, particularly by the Liberal Party, saying the 3% buffer that you add on to the interest rate you're going to pay to determine your serviceability is too high, and that's limiting young people at the moment in particular. And back then, the buffer was only 2%. In December, APRA of 2014, they said it had to go to 2.5%. So that also limited lending. But what they also then did was the floor rate that you had to assess at was 7%. When rates were very low. So it was either plus 2.5% or 7%, whichever was higher. So they really restricted borrowing capacity. And then in 2017, they put a cap on interest-only lending because so many people were taking out interest-only loans. Again, historically, that might have been around 30%, and that was the cap they put it at. But 45% of borrowers, some lenders even more, were taking out interest-only loans on all their loans. So, so look, basically they made some major changes took place over that period, and it impacted the property market. So nationally, 2015 property growth was 10 to 11%. 2016 it was 5 to 6%. By 2017 it had come down to just 3 to 4%. In Sydney and Melbourne, the changes were more stark. 2015, Sydney was growing at 16%. 2016, it dropped down to 10 to 11%. By 2017, it was down to 3 to 5%. And by 2018, Sydney prices went backwards by 8%. And Melbourne followed a similar trajectory as well, 13% in 2015, down to 9 to 10% in 16, 7 to 8% in 17, and then the prices fell by 5% in 2018. So look, that's a bit of a history lesson on APRA really taking the sword to borrowing for investors over that period.
Look, they also that was a perfect overview, Dave. They really wanted to increase household savings and bring down owner occupied debt as well. So effectively, they wanted to see LVRs increase, and they did that. I won't say superbly; it was brutally. It was a very blunt instrument, and it really hurt. And I remember at the time wanting to purchase a property myself, and the hoops that we had to jump through were extreme, and every investor was experiencing the same thing. And I remember the mix of investors and owner occupiers that I was working with within my business completely changed. I was almost 100% owner occupier for that 2017, 2018, 2019 period. And if we cast our minds back, there are a few other things that were influencing the property market negatively. I think there was a lot of the Banking Royal Commission probably ramped things up for the lenders as well. They were on their best behaviour. We also had the federal election looming, and then we had
the promise of negative gearing and capital gains tax election.
Yeah, it was a tough time, wasn't it?
Bill Shorten. Yeah, it was really tough.
Both times.
Yeah.
Yeah, of course.
It's back on the agenda again.
Oh, yeah.
Papers.
That's an interesting one.
I'll believe it when I see it, Dave. Honestly, every time they try and tinker with it, it doesn't go well.
Not if they take it to an election. The risk is making changes after they win an election.
Yeah, I mean, Shorten took it to 2 elections and lost both of them, admittedly by very narrow margins. Obviously, it wasn't the only thing he took the election. They were talking about real action on climate change, but I think they also approved the Adani mine as well. So that was a difficult thing to kind of straddle. And yes, it's in the news again. And I think every now and then the Labor government will kind of test the sentiment, and it got smashed very quickly. And actually had a journalist call me up saying, I've got the address of a property that Mr. Albanese purchased in Sydney in 2015. Could you model the tax position? I thought, gosh, sometimes life is strange, and got in the newspaper talking about his negatively geared property he bought in Dulwich Hill in 2015 for, I think it was over $1 million. It was about 1.1, and in 2015, investors' average spend would have been a lot less than that. I mean, today it's $650,000 according to our data. So it's kind of not representative of your average investor, but an interesting one. And let's talk about LVR for individual loans. Overall, LVR is a viable measure of health that a lot of investors and businesses use. Cate, with your investment property portfolio, can you talk us through the concept of overall LVR and how that can be reduced or, let's say, optimized?
Yeah, so obviously if you've got more than one property, you've got more than one loan most likely, you'll have varying LVRs for them all. And LVR is a bit of a moving target because it depends on what your value of the property is, whether you've added some value yourself, whether the market's been performing really well. So an overall LVR number is taking into account all of your entire wealth position and your debt position. And it's literally just adding them all up. So as Dave explained, calculating LVR, what's your overall loan, what's your overall value, and what's the ratio. And so sometimes you'll find that you've just purchased a property, you might have gone into high LVR territory to get it, or you might have had to leverage hard against it to release some funds for something else, and you could find that you're in mortgage insurance territory, or your loan is above 80% for one, but then others you've owned for a long time, they've been performing well, the market's grown and they're sitting at maybe 50% LVR. So your overall LVR is a real figure that most people will have a finger on the pulse of, because it demonstrates how well you're managing your debt. And of course, if you're looking at retaining properties, or facing retirement and reducing your debt, you need to be very mindful of your overall LVR. Now, that leads me to cross securitization, which is a different beast again. And that's when you've got one loan covering a combination of properties. And a lot of people think that it's an evil product or something to avoid, but not necessarily. I think cross securitization cops negativity unnecessarily because there is a time and a place for it. Dave, I think this is in your wheelhouse. So are you okay to talk to our listeners about what that is and what the pros and cons are and what you think the ideal scenario is for cross securitization?
Yeah, so I'll encourage our listeners to listen to episode 99, where we unpack this pretty much across an entire episode of cross collateralization, myths busted, and best loan structures. But look, the main reason why cross collateralization is avoided by borrowers is because they worry the bank may force the sale of all properties securing a loan when there is a repayment breach. So that is what people are concerned about. So ultimately, it's a risk management strategy. But look, I think if you've got an LVR of sort of below 80%, really probably in the 70 to 80% range across all your properties, you have you have reasonable savings buffer and reasonable serviceability buffer. I don't really have a problem with cross securitization because I think it can really make your loan structure a lot simpler, and you can manage risk in different ways. And really the worst case scenario is the bank having to sell you up on a property. But if your LVR is at that level and you have other buffers in place, then you can make your own decision to sell a property or more if you need to recover your financial circumstances. So the benefits of cross securitization is you just have one loan for each individual property or debt purpose. Okay, so that keeps your lending really simple. So you might have borrowed 106% for your latest investment property, but you don't have to split it out into one loan of 80% secured against the new purchase and one loan of 26% secured against the other purpose, and end up with this really sort of complex set of loans that's hard to follow and manage as an investor. And anyone who owns multiple properties and has multiple loan splits, and you might have loans for business purposes, loans for shares, they'll know what I'm talking about, where it can get really complicated pretty quickly and you can lose track of things. So, cross securitization allows you to have one loan for each property and or purpose. No mixed debt or mixed purpose debt where you combine like non-deductible and deductible debt, which isn't good for you because it doesn't allow you to maximize your tax deductions. I won't break that down any further right now. It's simpler, obviously, to track your lending. It's simpler at tax time. You have fewer loans. You're probably likely to have fewer savings or offset accounts. It can allow you to just deal with one lender rather than going across multiple lenders. If you keep it all with one lender, it makes it easy to keep it all with one lender. And some of the advantages of keeping it all with one lender is you will have higher debt with them, which allows you to get better interest rates and have lower fees. There's only one discharge fee when you sell a property versus multiple discharge fees for each individual loan that is discharged. So you can save money if you do sell a property. It provides you with the ability to access the combined equity across all your properties in one simple loan each time you go to borrow new funds. And there's only one lender to apply to for each loan. So there's some of the positives of cross collateralization. Some of the positives of one security per loan. I mean, as I said, the main benefit is you have a lower risk strategy in that if you want to sell a property, it only has one loan secured against it, and that keeps it pretty simple when you sell the property. This is probably a type of thing you'd want to do if you have a high risk investment strategy that you might have high LVRs. Like I said, if you're borrowing above 80%, then this would make sense. If you have lower savings buffers or your serviceability is weaker, your properties are less likely to provide capital growth, perhaps because you've gone with a real sort of cash flow, high yield strategy. That might be reasons to have one security per loan. What else might there be? Your borrowing capacity can be enhanced when you use multiple lenders, and so that might be a reason to do it, where you might have one loan with a major bank and then one loan with like a second, third tier lender like Liberty, which increases your borrowing capacity. It might help with keeping ownership and guaranteeing and loan borrowers separate as well, particularly if you spread it across different lenders. So, look, they're probably some of the reasons to do it. But I think prevention's better than cure. I think you can manage your risk by having good savings buffers, room to move with your LVR, income protection, life insurance. You can look at fixing some of your debt, and therefore you don't have to worry so much about having cross-collateralization.
Thank you, Dave. That's a good summary, and of course, check that previous episode for the meat and potatoes on that one. Before we go into the gold nuggets, getting back to LVRs, when I have a conversation with property investors that are multi-portfolio owners, and they sort of share, the number of properties or the value of the properties, my next question is always LVR. Because let's say you have $10 million worth of property and I say, what's the LVR? And if they say 90 or 45, it kind of tells me a little bit about their risk appetite or where they are particularly in their journey. So, for example, someone like Cate might be sort of nudging the way down to a lower LVR because that's the strategy that she's at. Whereas if you are perhaps in your 20s or your 30s, it would make sense to get the benefits of the leverage because you're not about to sort of sell down and try and live on the cash flow. Could you guys chime in if you have some thoughts on whether it's a positive or negative for property investors or indeed the market?
Yeah, for sure, Mike. I think, particularly in a moving market, a high LVR is not a negative thing at all, because if it takes you 2 years to save your 80%, your 20%, and the market's moved more than that amount of saving, you've done yourself a disservice. As Pete Kalizos said, it is the cost of doing business. I don't love LMI, but let's talk about how most people pay lenders' mortgage insurance. They capitalise it, so they add it to the loan balance. So over a 30-year loan term, there's a portion of your loan that's being paid on an insurance premium that's not benefiting you, but it is the cost of doing business. So getting into the market early, particularly when the market's moving in a positive trajectory, you don't want to be left behind, because the difference that it can cost you is being priced out of an area that you could have afforded.
Yeah, look, I think, the pros are you have to don't need to save as much of a deposit. You can obviously get into the property market sooner and get the benefits of that. And, it allows you to begin growing the value of your asset base sooner. So the power of compound capital growth. So that they're certainly the pros.
And music to your ears, Mike, it's a tax deduction.
Yeah, if you're an investor.
Yeah, and I think when it comes to generating wealth, I mean, leverage is a superpower, and compound, and of course time. You add those three magic ingredients, you've got all the recipes for success.
Great cocktail.
Yeah, it's all right. Well, we've had quite a whirlwind episode on LMI, and what was the other acronym we had? LVR. So we've done a couple of clangers today, but hopefully that kind of gives you a peek behind the curtain for if these are new concepts for you. And of course, you can go into the back catalogue for some more detail on that. But let's go into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is all about managing risk when you're in a high LVR environment. So if you're looking at making an offer on a property and you've got your loan pre-approved, but you're in high LVR territory, let's say you're at 95%, you need to be absolutely certain that you're getting it right with the price if you're not making a subject to finance offer. Because if that valuation comes in a bit lower than the price that you've paid, you'll need to bridge that differential. And sometimes LVR can be really handy when it's a bit lower, because that can be adjusted in the unlikely event of a valuation shortfall. You can go into higher LVR territory and not have to chip in more. If you're already at a high LVR, you need to make sure that you've got that backup plan just in case you've got your pricing wrong.
As a first-time buyer, I would suggest don't be afraid to borrow a high LVR to get you into the property market sooner. And as Peter Kalizos said, LMI is the cost of doing business. And if you're an investor with a multi-property portfolio and your LVR is under 80%, I would not be too worried about cross-collateralization if you can manage your risk and have buffers in other areas. That provides you with time for that worst case scenario of having to sell a property. You can make that choice in your own time, because the main reason to fear cross-collateralization is if you're worried about the bank having to sell you up and the repercussions of that. So, be open-minded to that if you're a multi-property investor with an LVR beneath 80% and some other buffers in place.
Love that. And I've heard a lot of people sort of say, oh, I'm really trying to avoid LMI. And I think, look, it's a cost. Pete says it's a cost of doing business. It's not a cost that you have to incur to do business, but it might mean that your timeline changes. You might not be able or ready to do business until you spend another 2 or 3 years to actually save up to be able to have an LVR where you're avoiding that lender's mortgage insurance. But these things can be calculated and modeled. You need to consider, well, what would be the actual cost of not being present in this property market that I want to transact in for 2 years? And you can often find that the cost of LMI pales into insignificance when it comes to the value of the equity growth if it's a fast-moving market, as Cate said.
100%.
All right, well, that was an
Good episode. Yeah.
On LMI and LVRs. We've got all the L's, all the three-letter acronyms, and thank you for sharing all of that gold from the both of you today, and we'll see you next week.
We'll see you next
next week, guys.